the only thing that historically has changed the timing of the cycle is kind of world war. Unfortunately, we are in a situation now where potentially skating quite close to the edge of something going wrong. Unless, of course, the news is totally fake and actually it's all performative. But I mean, some of the stuff going on around the world is really quite grim. And that is going to have consequences. If it has consequences before the peak of the cycle, we all get dragged into some kind of major conflict. That clearly might change things.
We are here with Akhil Patel. I'm pretty excited about this one. I've been following Akhil for a while. We did a webinar with Adam. I think that might have been March or April. And this is like when chaos, nobody knew what was going on. And he presented the 18.6 year cycle, which we're going to be talking about. And I remember during that presentation, everybody was in fear. And you said it's about to go bonkers. And I was sitting there and I was like, man, that's a pretty bold call, and I think everybody was in fear. So, and then that turned out to be true. So I was like, all right, I'm going to start following this guy. And I have ever since. This was the first that Phil wrote, The Secret Life of Real Estate and Banking. This one's pretty dense. Akil, you just wrote this book, The Secret Wealth Advantage, which I think is a little bit more digestible, especially for the average person that wants to learn about the real estate cycle. And I'll kick it over to you and let us know, about the company and how people can follow you. But I know this was like maybe a family business that suffered due to the 2007, 2008 crash. And you got interested and wanted to get into it. But just give an introduction and introduce yourself.
Thanks so much for having me on again, Fletcher. It's been a while. And yes, I think it was kind of deepest, darkest pandemic time, wasn't it? Or maybe where you're sitting, it wasn't that dark. But where I was in London, it was pretty grim. But yeah, no, I made that call on the basis of my reading of, the 18-year economic real estate cycle. And we were at the middle point of the cycle, and you tend to find that the kind of recession difficulty in the middle point of the cycle is relatively quick and easy, not easy to get through, but relatively quick to get through. And it leads into a more explosive second half of the cycle, which is what we got. And yeah, I did get into the whole idea of wanting to know about cycles when my family's business had difficulties in the 2008, 9, 10 period, because banks were under such pressure. They started calling in loans from small businesses, which, if you're a small business, you don't have access to bank credit. It can be really difficult unless you have very significant cash reserves. And it caused a lot of problems for us. I basically thought to myself, well, we can't go through this again. We need to be prepared, because it was pretty obvious to me that there was going to be another crisis at some point. I didn't really want to have to go through that. So I decided I was going to investigate what was going on, why no one seemed to be talking about the 80s boom and crisis of the early 90s in relation to what happened in the 2000s and then the 2008 financial crisis. Because I thought the two episodes had many similarities. And so that got me onto the idea of an 18-year cycle, and I investigated a bit further. I talked to people who've actually researched it for longer than I have. Bill, my business partner, whose book you just held up, was one of those guys. And just to reintroduce the idea of the cycle to those who probably don't remember my previous appearance on your podcast, it's an 18-year cycle. It's responsible for the main periods of boom and bust in Western economies and has been for over 200 years. It's primarily driven by real estate, which is why it's also referred to as the real estate cycle. But at the end of it, you always get an economic crisis. So it's really an economic cycle. It's roughly 14 years up and 4 years of crisis. And the 14 years up are themselves two halves of about 7 years interrupted by a mid-cycle recession, which we got in 2020, 21, as I've mentioned. Other than the world wars in the 20th century, it's pretty much repeated like clockwork for well over 200 years. So it's a cycle that you can then time your investments around because a lot of common things repeat each cycle. Obviously, the nature of society and our economy is very different each cycle, but there is enough common themes and dynamics that you can create a sort of a guide to the future, which is what I try to do in my book.
And basically, I think it's like, 4 down, 14 up. So we'd be in the later stage of the cycle. And so people have a background on this. This was predicted by especially Phil in the 2005, 2006 period. It's like, hey, we're here, and based just on this formula. And, you had the .com and you also had 9/11. So you have these little mid-cycle corrections as well. This time we had COVID. We just had the presidential election. To me, everything's shaping up for it too. But I think a lot of people, the question I want to know is like, hey, if this is an 18, and a half year cycle, and I think there's give or take, a year on either side outside of times of war, which I think everybody would agree we're in right now, that puts us somewhere around like late 2026 for what you would see. And once again, to give background, this is all about the debt and the credit. Akil, so you know this, I actually in 2008 invested in Washington Mutual. I was either that or Bank of America, just because I figured the bank, and it's fresh out of college, and Washington Mutual went under. And then I remember seeing a quote in a book, I think it was The Greatest Trade Ever, where this guy who was a mariachi dancer in California was trying to buy like a $700,000 home, couldn't prove that his income, on W-2. So what they did was he just stood in front of the house with his like mariachi outfit, got stamped and approved by Washington Mutual loan. Obviously, these were the types of loans that are given. And I was like, man, this was the bank I invested in, but anyway, it's always about the credit. So just where are we at? Like, it seems to me that the credit is a little bit harder to read now because, at least in my opinion, the banking in the United States seems to be a little bit more conservative than maybe it was at this time. So what are your thoughts on where we're at and where's the credit?
It's a good observation. Just to kind of situate where we are now so that, everyone who's listening to this is clear. 2006 was 2007, 2008. That was around the peaking years of the last cycle. We probably started the current one around 2011, 2012. There's never one day when the cycle starts, but at the start of 2012, we were still talking about triple dip recessions, and we had the euro crisis, and Mario Draghi saying he'd do whatever it took to save the euro. We had a lot of different difficulties, but that was around the time that we started the current cycle. If you then project forward roughly 14 years, you get to 2026. So we are, now a couple of years at most from the peak. It doesn't mean you get the crisis right at the peak. You might have a year or two where things kind of build, and then you get the really difficult period. But it's a broad framework to plan around. I think that's kind of what we're looking for. It's indeed very heavily influenced by what banks are lending for and how willing they are to lend and how many safeguards there are around that sort of process. One of the reasons why credit's so important is because most of what the banking system does is to lend money for people to acquire real estate. And so, that's kind of the bulk of the activity in the banking system, which is why it can really push property prices high and over the top. And when it comes down, it can really come down and bring the system down with it. It's also fair to say that banks themselves are a bit more conservative, partly because the regulations that were put in place at the end of the last cycle were pretty significant. But, they've been lobbying very hard to be relieved of some of them and so on, because ultimately lending for real estate is a very profitable activity and they want to do more of it. And they want to allow all sorts of different things to be counted as their capital to meet their capital adequacy ratios. And that's the area of contest. But what you also find actually in different cycles, and I detail this in the relevant chapter in my book, is that often towards the peak of the cycle, it's not the banks that are doing the most lending. It's often shadow banks or non-bank institutions. That's where the growth in capital comes from, and they're often not bound by the same regulations, and so they can do more than they can grab market share from what banks might see as their traditional kind of turf. And in fact, the securitization kind of thing that we got in the last cycle was a bit of that. The banks were the kind of front office. They originated the loans, and they did so in a very dodgy way in some cases, as you've just described. But then they knew that it didn't matter because they were going to offload the loans to other investors, and so it kind of had no incentive to really to make sure they were good, because they were ultimately interested in the fees and the kind of upfront benefit, but not the long-term thing. So they were just going all out for market share. But it was the presence of this secondary market that enabled all that kind of really terrible behavior. We're not getting that to the same extent now, but you are getting people that are muscling in on this activity. You've probably heard about private credits. It's not necessarily directly for real estate, but it's for different assets, which then enables more credit in different parts of the market. There are any number of different sort of finance providers, a lot of capital maybe not going into real estate in quite the same way as we got last time, because that was the real game in town after the dot-com bust. This time around, it's probably a bit more mixed. It's going into other speculative things like a Bitcoin or well, maybe Bitcoin is considered to be safe compared to some of the other kind of crazy things that are available. And, these are very significant. I think the point is, though, that you have a lot of capital flowing around the economy at this point in the cycle. Some of it's provided by the bank, some of it's provided by non-banks, but ultimately a lot of it is going into speculative activity that can go over the top and that can come down. And when it comes down, it has very wide effects that no one can really predict in advance. And I think we're seeing the same process over and over again.
So I remember last time we spoke, you said it could be like even like Apple Mortgage. And I've tagged you on a couple things where, you see it's almost like the zero down loan, but it could be something like crypto. And I guess those gains people are getting more speculative with.
Yeah, people are leveraging their crypto investments. And you can go to ridiculous levels, like 100x. And it's just mind boggling really that people could take this much risk on something that's already very volatile. Anyway, I don't want to offend any crypto bros.
No. I'm in the same boat there. Like, more power to you if that's what you're doing. It's just something that I don't necessarily understand.
Well, I think it's more power until the market turns against you, and we know that those are very volatile assets, and they can turn against you, and it can be kind of very detrimental to your financial well-being. But anyway, be that as may, it's a period where speculation. And by speculation, you mean you're investing in assets not on the premise of, fundamentals today. Like if you buy a stock, it's on, a company that's good quality and it has earnings and it has growth prospects and so on. It's simply buying something because you feel tomorrow you're going to find someone who's going to pay more for it. And you don't necessarily have any real rationale for thinking that, other than the fact that yesterday it was lower than it is today, and therefore tomorrow it's going to be higher than it is today. So you're basically extrapolating a trend, and those things can be very powerful for a number of months or indeed sometimes years, but they're not based upon any kind of fundamentals. They're just based upon ever increasing flow of money or capital into that, and that process can reverse very hard. And when it does, it's difficult. Now, if it's not backed up by bank credits and people are not leveraged, then it may not, it may have a bit like Bitcoin when it crashed in say 2018, didn't have any widespread effects. And when it crashed again in 2021, again, it was, it had there's some big crypto people that were quite well connected who were found to be doing fraudulent things, but it didn't have a big repercussion on the financial system. We had sort of other things to worry about. But, when it's tied in somehow to a bank who's making lots of money lending, so people can trade on margin, or, if it's somehow linked to some other assets, maybe in the real estate market or something else, it can, and then the banking system and financial system being so interconnected, it can then sort of ripple out into the broader economy. And what we tend to find that ultimately, whatever the actual most visible speculative activity is, it's somewhere somehow tied into the real estate market. That's the thing that you need to watch very closely over the course of an 18-year cycle.
I mean, you mentioned speculation, and I think back to, let's say the last crash. You have this FOMO, right, where people feel like they're going to miss out, and whether that's like Bitcoin, whatever it is, right? And for me, this is interesting because that's a very like qualitative, and so once again, when you made that prediction during the pandemic and it shot up, I was like, man, I'm on board. I want to see this. So I've actually, I think probably maybe 3 people have gotten your book. I think, but a lot of people that I run this by, even, like commercial real estate, like quant guys, it's like they want to have more of like some formula, and it feels like they just brush it to the side because it's not like, okay, well, that when we get like this per square, whatever it is, it's not like some sort of formula. And I feel like a lot of people that I've spoken to and mentioned that, I'm a believer, and it's just kind of like, oh, this is kind of like voodoo. So I'm just curious, do you get that, or do you find that some people are just like, hey, that's not necessarily?
I suppose to a certain extent. I mean, I don't necessarily have the interactions. I mean, commercial real estate investors and so on, they've had we can talk about that as well if you want. But they had a difficult time and so on. But they have indicators when you're an investor in certain markets. You have certain indicators. It's cap rates, or it's bond yields, or it's it's demographics or whatever. They need to kind of see that, and that that's probably how they make decisions. And so something which is it's actually a rather large and intricate framework of things to look out for. Some of which is you could argue is based on anecdotes, and I don't mean that in a sense that it's therefore not worthwhile. It's just that you can't encapsulate things in a number. You actually have to read and observe what's going on around you, and your anecdote is hopefully symbolic or typical of something that's going on more broadly, but you don't necessarily have a numerical thing to look out for. And how you can extrapolate that from the historical record where you don't have things measured in the same way as they are now, it's difficult. And also it's difficult because some of these indicators don't actually get to fundamentals. What they get to is their kind of symptoms. So sometimes you can have a real estate crisis when interest rates are very low. You can have a real estate crisis when interest rates are very high. So it's not the fact that interest rates are at certain levels or other levels which is the key factor. It's the direction of travel at a certain point in the cycle based upon when banks have extended too much credit. Is now getting to measure that is very difficult because banks obviously not going to tell you they've overdone it. They're going to say, oh, we're obeying the current standards. Sometimes actually they engage in fraudulent activities and they're going around it, but that's a different issue. So it's quite difficult to really sort of stay in very numerical terms how this all works. To finish, that there's a couple of things. One is that it's a framework that's fundamentally based on what I regard as a fundamental law of economics, which is the law of economic rent. And I detail how that sort of dynamic plays out in the course of a cycle in my book. But essentially, it's land is a monopoly asset. I mean, the US is full of land. It's not no shortage of land, but it's land in good locations where people want to work and live. And it's unique. Every parcel of land is unique. It's scarce, and ultimately, it takes all the gains of economic progress because if you're a landowner in those locations, you have monopoly pricing power and so on. And so it absorbs all of the gains of economic progress, which is why it's good for collateral, why it can be speculated in, and why things are driven over the top. We don't really measure land values in any detailed way. And therefore, that's one of the reasons why there's a certain blindness to the cycle from that point of view.
On top of this, you have all these quotes, like when you have people like Ben Bernanke saying, we're at new plateaus and we've reached this. I mean, it's easy to get wrapped up in this.
They feel that they can manage the economy. And look, I listen to a lot of macro sort of podcasts and interviews with people who I really respect, and they have, access to vast amount of data and so on. But what I've actually started to notice over the last 2 to 3 years in particular, when there's been a series of things that people have not been able to explain, they create data and they wrap a story around what's going on. And they might say, well, we're being consistent in how we put the story together. But I'm starting to feel that they're kind of in the business of creating plausible narratives. Now, I mean, they're doing so sincerely and so on to benefit their sort of subscribers or their investors or whatever it is. But I don't feel it's actually an accurate reflection of fundamental dynamics of what's going on. And for that, I go back to the real estate cycle because I feel, and I make the claim in my book, and you can read and see if you're persuaded by it. The dynamic is based upon how the economy actually works, and therefore it's amenable to a degree of prediction. And I think what I've written to my subscribers over the years has been, from that point of view, relatively solid.
So, safe to say, last cycle it was mortgages in the United States. I remember last time you mentioned that there's a possibility that this is much more, and this was global. It was global, no doubt about it, that the epicenter could be something like maybe, I don't know. And I don't know enough about like Evergrande and like China, or Dubai seems like a very, I think, market that, I'm not going to say speculation, but are there other areas? And then we have like the line in Saudi Arabia, you start talking about the tallest building thing, so do you think that there's a chance that this cycle centers around somewhere outside of the United States?
Financially, it's relatively interconnected. So it doesn't matter in a sense where it starts. It will affect everything. You tend to find, and probably partly for the reasons that you said earlier, you tend to find that maybe if one area was really affected by the last cycle, it might not be quite to the same extent. And, what you were saying about how lenders are maybe a bit more conservative now than they were in the last cycle, that's probably a symptom of that. In the 80s into the early 90s crisis, the really big kind of standout example was Japan. Didn't really have quite the same cycle in the 2000s leading to 2008 crisis. They were badly affected by it. Dubai is quite interesting because there are some areas which seem to have a cycle every time. Dubai might be one of those. Things are going gangbusters again. Florida, actually, funny enough, is another area where every time things just go way over the top. Whereas maybe in other states, they don't in successive cycles. I've seen a lot of development going on in places like Indonesia and, in parts of Africa and so on. So there's definitely a lot of activity. It seems to be coordinated from a timing point of view. I think the US is still the kind of leader in all of this. What role China will play, I don't really know, to be honest. And, I hold my hands up and say, I don't think I really understand China well enough. I'm not sure anyone really does. On the one hand, there is a lot of property speculation in China. There's no question about that. Or there was until they started to do something about it in 2017 and onwards, and it got really bad. And when the interest rates went up, it sort of put a lot of these companies that actually had dollar exposures into trouble, together with the fact that the government wasn't doing supportive things like selling land and backstopping, developers. So it's been a pretty difficult time. It doesn't seem, though, that it's has the contagion effect that you might expect. Maybe because the banking system wasn't in trouble, and maybe that's the more important piece. Or maybe it's because, from a real economy point of view, China is not as connected to the rest of the world as, at least, kind of in terms of exporting these problems. That doesn't sound so plausible to me, actually, because I know, for example, if China is not doing stimulus, and commodity prices don't do as well as they would in other eras. But, nonetheless, I think China is a little bit of a conundrum, regardless of the fact we don't really have enough history to know if China has a real estate cycle. We don't know if it has a real estate cycle that lasts 18 years. And we really don't know if that 18-year cycle, if it does have one, times with the US. So It's just something that I watch as far as I can, but I can't really say more than that. From the point of view of the rest of the world, it seems that everything is working as you would expect in terms of timing, i.e., we've got to this point a couple of years out from potentially the peak of the cycle. At the start of 2023, everyone was certain that the US would be in recession. It didn't get there, despite the fact that you had the Silicon Valley thing in addition to interest rates. I think this year people were now saying, well, things will be fine as long as the Fed cuts, and they thought that the Fed would be cutting all year. And that didn't happen. And yet, things have, ticked on quite well. In fact, the US economy has grown rather strongly. The news has got very distinctively more positive over the course of the year. And now I feel, after a pretty good year in the markets, and crypto going up and other things, property prices recovering in a lot of places, commercial real estate starting to look a lot better than it has over the last couple of years, you're starting to feel like, and this is, I think, very much aided by a change in government, there's really a feeling that animal spirits are now unleashed, I think. And you're starting to see people talk about a new era, and this is going to be different, and it's all going to be different, and Elon Musk is going to reduce the deficit by 2 trillion, and all this kind of hope. You're starting to see a lot of hope. I don't mean a hope in a good way. I just mean this kind of hopium kind of stuff that you need to get you to the peak. You're really starting to see that, and this is right on time. So I'm not really seeing this cycle play out any differently to previous cycles that I've studied historically.
Funny you mentioned that, because I was going to go with the T word, Trump. I would think, I was like, hey, if it went one way and it went whether, it seems to me that this was a more bullish outcome, and it just makes everything, in my opinion, line up better, because it's like this, new wind in the sails, whether that's realistic or whether that's imagination. That's like the feeling I'm getting from especially US people right now. You mentioned, because it's all about debt. And I mentioned this to a guy who, lifelong Republican, and he's just, hey, I asked him this. I said, look, if the Republican gets in, do you think the national deficit, the national debt that's at 36 trillion, I think right now, goes down? And he said, no. He goes, I think it's going to go up regardless of who gets in office. So does government debt play any role in this, or is this just, it seems like this is like a number that no longer matters, but
people
obviously it doesn't. So,
well, I mean,
so maybe just your thoughts on the administration. I think it sets up great for this to play out. And then also, does the government debt have anything to do with it?
It does set things up in a better way from the point of view of me being right at the top of the cycle, I think. Not actually, to be honest, I'm not sure that the change in government actually will make that much difference. I just think that the news is a bit, in a sense, a bit clearer. And also, I think if Kamala Harris had won, it would have been a divided Congress, and that would have, and let alone setting aside the idea that actually Trump would concede the election, which that he wouldn't, or threaten not to. So it would have created more distractions, and that, of course, is not great for business investment and so on. It's been a much cleaner result. I don't know if that's necessarily just because of Trump. It's just the way it's played out. Deficits tend to go up much more under Republican presidents than they do under Democrats. I think that's quite clear historically. Not really the party of small government. It might be the party of kind of lower taxation, but then it's not a corresponding reduction in, defense spending or whatever it is. In general, and the US in particular, deficits tend to be stimulus into the economy. So it's the US government putting money into that pockets of people, whether it's done via the bond market into generally wealthy people and institutions, or it's done through spending for entitlements, or it's into kind of investing in the economy in better schools and hospitals and roads and infrastructure. But the deficit will tend to stimulate activity. So, I think Trump is a big spender. He's by no means a traditional Republican. He's, to be honest, probably more, in that sense, more of a Democrat. And he indeed was a Democrat for a long time, is when he's sort of considered running for office in the 80s. So I think Trump will have instincts to spend, and that will be very bullish for the next couple of years. I would be very interested to see if Elon Musk does indeed report back to Trump on 4th of July, 2026, with a plan to reduce the government deficit by 2 trillion. I think this is all kind of pretty much nonsense. But if that were to happen, that would actually be a trigger potentially for the end of the cycle. Because if you took that much money out of the economy, say in a very short space of time, it would start to bring the US economy down. And that might be the kind of, so that's one thing that I'm actually looking at to see what happens around that time, because that's kind of times really neatly with the peak of the cycle. More realistically, it's probably not going to deliver what that is intended to deliver. It will obviously trim things at the margins and so on. Of course it will. Probably what will be is that the high levels of continued spending and deficit and so on at this point in the cycle pushes inflation up, which will potentially cause the Federal Reserve to need to change course and start raising interest rates or tighten or do something that it's not doing now. And that will cause things within the financial system to crack, and that potentially will be the trigger. But it's all building up nicely to a peak. And so I'm definitely on the lookout for a couple of good years, but for the point at which the thing will turn.
That feels like a episode of The Apprentice or something with Musk getting in. So that's what creates the noise itself.
Actually, the 1920s, all these billionaires appointed to positions of power. Andrew Mellon as the Treasury Secretary and other things like that. And I probably should not be too controversial because it distracts us from the main point. But it has this kind of feeling about it now. Late 20s, roaring 20s, and so on. The big business guys, they know how to run things sort of in charge. But we know how the 1920s ended. It's not always what it seems. So it'll be interesting. All I can say is let's see how it plays out. It seems to me that it's all building into how I forecast. And so you can ride it up. And, I think that's, I certainly will be encouraging my subscribers to do that. But we need to be prepared for the moment at which it stops, because it will at some point stop and come down again.
Something that's pretty interesting was the tallest building. It seemed like every cycle. And to me, it's more like maybe it's just development in general. Like you might be talking, it might be like the tallest, or it could be like the line. I think that's Saudi Arabia, but just to show people, it's a last cycle, it was the Burj Khalifa. You have like the Chrysler Tower, you have all these largest buildings, and it just kind of shows the party's getting out of control, and we're going to do the biggest one to show everybody that the boom's happening. And these just show, like the Burj Khalifa opened up in the worst economic
crisis.
Can you show a couple of examples on?
Yeah. So, the premise is, or the dynamic is that in order for someone to conceive and then actually start constructing one of these, world's tallest building, they put a place on the map, or they consolidate a place. They show this is where all the action is. Where all the action is means that land prices are going high. So to make a site pay, you've got to build higher, so you generate more rental income for a particular site. But it also speaks to big ambition, and very crucially, it speaks to very deep pockets in terms of finance. And all these things come together at the peak of the cycle, because, that's when finance is available. That's when people are quite optimistic about the future. And that's when land prices are really high. And so you definitely won't get someone proposing the world's tallest building at the start of the cycle, because you can't find finance, and land prices are low, and everyone's fearful. But the opposite is true at the peak of the cycle, and so you always get it. It's construction starts just before the peak, and when it's actually built, you're usually in the subsequent depression. And so we had the Burj Khalifa, which I believe opened in 2009 or 2010, I can't remember. Very interestingly, it was supposed to be called the Burj Dubai, so named the Tower of Dubai, but Dubai itself needed to be bailed out by neighboring Abu Dhabi, so it was named after the ruler, which I thought was quite funny. You had the Shard in London, which was at the time Europe's tallest tower, which opened in 2011 or 2012. So it was again the start of the current cycle. It was really quite depressed times. But if you go back in history, you can see any number of skyscrapers coincident with the peak and subsequent crisis. So the Empire State Building in 1931, which followed the peak in 29, or the Sears Tower in Chicago, which opened in 74, which was during a crisis. So it's a pretty reliable indicator for the reasons that I have described. And you're seeing that, was it the Kingdom Tower in Saudi Arabia, which will be kilometer high, if I'm not mistaken, or mile high, I can't remember. Plans change.
Crazy.
You have the line. So there's obviously a lot of money sloshing around Saudi Arabia. They're trying to diversify their economy. I mean, some of that is public funding led, and that might not reverse course quite as quickly, but it will certainly delay the projects very significantly. But you're seeing, was it the tallest tower in the US is now going to be in Oklahoma City, and in Australia and Africa and so on. So there's a lot of ambition from a building point of view going on, and a number of those will open up after the peak, and it'll be quite difficult to fill them with tenants and so on. Certainly not tenants who are willing to pay the high prices on which the entire scheme is predicated.
I know you've mentioned before that a lot of times, for example, with housing, I look at the US and I know people, clients that I have here that, wealthy from like Seattle, California, and they have to they've said that they're going to give their children their inheritance early so that they can put a down payment on a house because they've done everything right. They've gone to school, they got the jobs, they can't afford.
Yeah.
So do you think there's any sort of legislation from government where it's always well intended, this is the way you kind of would describe it, to help out the little guy, so to speak, that helps kind of crack open the dam for more capital? Or is this just something that's probably not so relevant, especially this?
It's very relevant. So you mean crack open the dams, you get a building of cheaper housing?
Yeah, and then it's really the credit to be able to do that. It's in the name of helping the little guy, but then it kind of gets exploited.
Oh, I see. Yes, yeah, they're counterproductive. I think during the U.S. election campaign, Vice President Harris promised, first-time buyer grants to help people get onto the housing ladder. And I don't know if maybe if you're below a certain income threshold or a certain location or whatever. I don't know the details, but that's precisely the sort of policy which is well intended. It enables someone to live the dream, as it were, of owning their own home. But what they do is directly push up the price of their home by the amount of grant. So it actually doesn't make anything better. Actually, it just pushes up house prices. Obviously, great for existing homeowners because their prices go up as well. But it's not good for getting people into the housing market. You have other things. You have, windows where you don't have to pay your interest costs. You have subsidized mortgages for a period of time, or you have, in the UK we have this thing called stamp duty, where if you buy a place, you've got to pay the stamp duty on purchase, and so you have stamp duty windows. The thing is, the entire system relies on a stream of new buyers to enter into the housing market. Once they're in, you can then trade up your housing equity to afford a bigger place. And by that time in your career, you're probably earning more, so you can borrow more, et cetera, et cetera. But if you don't have the stream of first-time buyers coming in, then the system stops working. And so that's why a lot of attention is paid to that. And I go back to the point I made earlier about how, land takes all the gains of economic progress, which means that land prices over the long run tend to go up much more quickly than wages. Even though, wages have increased quite significantly in the last few years, land prices tend to go up more quickly, which is why over time, what you can afford gets less and less. It's not in as good location. It's not as big. It's not as good quality, not as spacious, etc. That you can see that really sort of significantly with first-time buyers. So people have to buy later. They live at home for longer. They rent for longer, etc., etc. And it kind of creates a lot of intergenerational tensions because people can't get to the same stage in life that their parents did, and they delay things. And it has actually quite an enormous effect on, decisions on when to marry and when to start a family and where to locate and so on. So it has a lot of social and other consequences, and a lot of keeping the party going as politicians do, because, it's a vote winner to get people to be able to afford their own home. Well-meaning, but it is very counterproductive.
One more before you get a little plug in. You feel comfortable that everything is on track for the thesis and the research that you guys are doing, that uh, the way things are shaping up, that we're in the height of the boom, and it can continue, and there's a possibility that that has some sort of repercussion that's kind of like similar to the 2008 type, or 2007 2008 type bubble.
I do think that I've been pretty consistent in both the kind of forecast and the timing of the forecast ever since I've been writing about this. And I think I wrote my first piece probably back in 2013, 2012, 2014, sometimes, so for over 10 years. And I haven't deviated from that, and I'm not about to. I suppose there are two things to say. The only thing that historically has changed the timing of the cycle is kind of world war. And so, unfortunately, we are in a situation now where it doesn't necessarily feel like we'll get there but I mean, certainly we're potentially skating quite close to the edge of something going wrong. Unless, of course, the news is totally fake and actually it's all performative. But I mean, some of the stuff going on around the world is really quite grim. And that is going to have consequences. If it has consequences before the peak of the cycle, we all get dragged into some kind of major conflict. That clearly might change things. Hopefully that's not the case, but we'll see. And the other thing is, I suppose, there are always developments which maybe make the cycle look slightly different from time to time. And I mentioned the example of the 1920s a few minutes ago. What was quite interesting about that was that the actual cycle peaked in 1926. So real estate prices, particularly not commercial real estate in big cities, but other real estate peaked in 1926. But for whatever reason, things went on for a couple of more years. Partly it was political, it was a feeling of a new era. Partly it was because the Federal Reserve reduced interest rates to accommodate the UK going back on the gold standard. At the time, the UK, or the British Empire, was the world's largest economic bloc, and London was the centre of the financial world. And so, to accommodate the UK going back on the gold standard, the US reduced interest rates, and it really enabled things to take off. Now, obviously, we're not going to have something like that, but maybe there might be some development that might make the cycle seem to time differently. That's also a possibility. I suppose what I'm trying to say is I don't actually believe at the moment that we're off track, but, things might play out slightly differently. But, only a close reading of history and looking and reading the signs will enable you to do that. But nonetheless, I think from an investment point of view, I give my subscribers the framework, I give them the timing, I give them the things to look out for. And we should operate on that basis until the markets and events tell us otherwise, which I think is quite a good way to approach things, if I'm honest.
Yeah, it's super interesting. Akil, thank you so much for taking the time. So this is only like a year and a half old?
Yeah, it came out last July, so not quite a year and a half.
Yeah. So go get this book. This one, like I said, I liked it. You laid it out very well. And Phil's is great. It's a little heavy for, I wouldn't say like the average, but somebody that is very curious and wants to learn. Yeah. This one's very digestible.
I mean, I probably should say just very briefly that Phil's book is a run through US history since 1800. It gives you you can see the repeat through the telling of history. What I try to do is I just take people on a journey through an 18-year cycle. I try and distill what I've learned from history, including reading Phil's book, into the practical things to look out for.
Yeah, no, they're thorough, and we kept it pretty over the top there, just bird's eye view. But Akil, you could tell me what was going on in 1943 and what interest rates were there. So, but go ahead and give a little plug to the book and also the how do people subscribe?
Yeah, so probably the easiest thing to do is to go onto our website, which is www.propertysharemarketeconomics.com. And you can you can sign up for our free newsletter, which is called the Property Cycle Investor. And that gives you a weekly kind of update on the cycle and interesting items in the news and gets you into it. And then if you are interested to take it further, we have a couple of membership tiers that people can sign up for. But the Property Cycle Investor newsletter is probably the the way to start, and it's totally free.
I know Adapia is a subscriber too. And also, this is on Amazon, Secret Wealth Advantage. So go get a copy. Akil, thank you so much, man.
Thank you.
Sorry to drag you into it on a Friday afternoon in London,
No,
but I
always
appreciate
happy
it.
to talk to you and talk about real estate cycles.
I appreciate it. We'll be in touch, and we'll definitely be doing the next one. So thank you so much.